Everybody joining us today for Meet the Investor with Madrona. I don't know about the rest of the people on the call here, but I'm certainly delighted to kind of be, back in the saddle, so to speak, after Labor Day. Had a great summer, but really kind of looking forward to the fall and hopefully getting back to some degree of normalness in our daily work environment. But today we've got Daniel from Madrona. Daniel's been with Madrona for since 2015, and for those of you who don't know Madrona, they are probably the largest and most prominent venture fund in the Seattle area. They've actually been reasonably active here in Spokane. They've been involved in both Worldwide Packets and Second Watch. But I think I'll just turn it over to Daniel and have him provide somewhat of an overview of his background and what Madrona is looking for. And then we'll open it up to questions. And you kind of have two choices with questions. One, you can either send them to Cindy and me first, and we can queue them up, or just kind of wave your hand and we can turn it over to you. But with that, Daniel, again, thank you for participating today, and I'll turn it over to you.
Thanks, Tom. Really happy to be here and excited to meet more folks from out east. The quick background on me: I'm a principal at Madrona. I've been there for about 5 years now. Mostly work on investing in enterprise software at the seed and Series A stages. I'll get into more about Madrona and the areas where we invest, but the companies I work with tend to be a reflection of our portfolio, mostly application and infrastructure, and then on the consumer side, a few things that revolve around different types of digital communities. With regards to Spokane, I was actually the board observer on Second Watch for a while until their recent transaction with STT Telecom. But I've been out there a few times and looking forward to meeting more of you and answering questions. So I'm going to just pull up a slide deck here with some more info on Madrona. But really it would be great just to have people jump in with questions. It doesn't need to be super structured for the presentation or Q&A section. So the quick overview of Madrona: we were started about 25 years ago. Tom and I were actually just talking about the founding story of Madrona. So a group of 4 angel investors got together and wanted to make some investments out of their own checkbooks. One of them happened to meet Jeff Bezos, and apparently brought this deal, Amazon, back to his group of angel investors and told them about Jeff, and he seems like a smart guy. He's talking about this thing called the internet. And apparently the other 3 angels basically told Tom, "That's the dumbest idea I've ever heard. Who would ever want to buy books on the internet?" So the 3 of them, who were like the CEOs of companies like Delta Airlines and like the former head of the FBI and folks like that, very smart, accomplished people, they actually didn't invest in Amazon at that time. Tom did. And then he was on the board of Amazon for the last 24 years. I think he just stepped down last year. But along with that success, Madrona went on to raise a few more funds. So we're now on Fund 7, and we have an acceleration fund, which does later stage investments. But throughout that entire time, we've been investing in early stage and focused on the Pacific Northwest. So something like 85, I think, % of our companies are based in Seattle, Portland, Vancouver, Washington State, Oregon State area. And in general, what we're seeing in the Seattle region is not only are we home to 2 of the 3 largest companies by market cap in the world, we've become the cloud capital of the world, we've become an AI capital of the world, and also a bunch of different innovations around marketplace businesses as well. Here's a nice chart from CB Insights that we copied from them, showing that Madrona is the most active venture capital firm in the Pacific Northwest. There's also some folks in Montana, Idaho, and Oregon to call out, but at least in Washington State, we're the most active venture investor. One of the things that really differentiates Madrona, we think, versus other early stage venture firms is that a lot of the times when we're investing, we're really investing in day 1 companies. where companies are only getting off the ground and we're helping them start. So back in 1995 with our founding fund, Amazon, Aquantive, and NetBot were some of those examples. But throughout our 7 funds to date, these are just a few examples of the companies where we were investors from day one, oftentimes helping the founders start the company. So a few of the more recent ones that you might have heard of, things like Smartsheet, Aptio, and Redfin. In 2009, we actually incubated Rover as a startup within Madrona. And Aaron Easterly, the CEO, was an entrepreneur in residence with us and saw this project happening. He was actually a former advertising executive, but he's like, I really love dogs. Is this something that I could work on? And he ended up being the CEO and still runs the company today. More recently, we're seeing companies like Pulumi and Heptio and Exnor building more infrastructure level technologies. But you can kind of see over time how things have changed in the Seattle startup ecosystem. These days, there's a lot of infrastructure, a lot of machine learning companies versus marketplaces probably 10 or 15 years ago. Just pause here if anyone has any thoughts or questions.
And what is the average size of your seed and Series A investments?
Yeah, so I just pulled this data a few weeks ago. Back in 2015, when I first started at Madrona, the typical seed check was about $1 million at a $5 million post money. Today, the average seed investment looks more like a $2 million investment at a $10 million post money. Which on the one hand, it's awesome. Seed valuations have doubled, round sizes have doubled. On the other hand, the definition of what is a seed deal has changed a lot too.
Yep.
So it's really hard to say. we spend a lot of time laughing about companies raising pre-seed rounds at $20 million valuations or seed 2 valuations at $50, $100 million valuations. I think it's more about like the typical first investment that we're making is probably somewhere in the $1 to $3 million range. And the quote unquote Series A, maybe they have a seed or 2 seeds before that, is more like 8 to 12.
Yep. But in both cases, whether it be a 1 on a 5 or a 2 on a 10, you're ending up with 20% of the company.
Yep, that's right. Which I think that's probably like the median or the average that we're seeing, but definitely for a lot of the hot deals, we're seeing VCs end up more in the 15% range.
Yep. Now, are you typically doing equity investments, or will you participate in convertible bridge notes at that stage?
Yeah, we see both. So I don't think we're super dogmatic about convertible notes versus safe notes. I know there's some investors who just hate safe notes. It makes sense. Convertible notes are just better for investors. And I feel like YC has done a lot to push this idea of a safe note. One of the companies I worked with, they raised a safe note, got acquired. And it just seems like one of the most unfair things is you get your money back in that case. Whereas in a convertible note, you typically have some sort of 2x or 3x return.
Right.
But I don't know, YC has made this kind of the norm. So we're not going to push back really strongly and say that you need to convert this into a convertible note. I think the thing that we see more often is companies will raise one safe note or a convertible note and then raise another one on top of it. And then when someone comes in to do an equity round, now there's 40, 50% dilution coming in from the notes. And then we're adding more dilution on top of that. And then whoever is doing that equity round looks like the bad guy because they're causing all this dilution to happen, when really it's just that people didn't model it out before they took on the note.
Right.
But any other questions? Okay, I'll keep
Often
going.
have the shy group at first, but don't
no worries.
Raise your hand or ask a question.
I was just curious, Daniel, was Madrona involved as lead investor for Snowflake?
Sorry, you broke up right in the middle. I just heard Madrona and Snowflake, but it's a portfolio company. We're super excited about it. I just missed the question.
I was just curious if you were one of the lead investors in that as well.
Got it. So that was so we've historically had a bunch of early stage funds, and they've been very focused on Pacific Northwest, seed and Series A. About 2 years ago, I think, we raised what we call our acceleration fund. And that was based on a couple of investments in later stage companies like Accolade and Snowflake, where it wasn't the seed or the A, but we felt like we knew a lot about the market. We felt like we could be helpful to the team. We had some sort of connection to the team as well. So Snowflake, I think we invested in the Series C. We didn't lead the round. It was a check out of our core fund versus their new acceleration fund. But we invested in that round, and yeah, now we're super excited for this IPO, and all the news coming out is just incredible.
Perfect. You have, okay, excellent.
So just going through a couple more things here. I asked our head of investor relations to give me some slides that I could come like rep Madrona to the Spokane community with. so here's one of the slides that we show just on track record and history of success with some of our portfolio companies. But some cool numbers: $15 billion in aggregate company exit value. Obviously that excludes Amazon and what that would have been. 20 IPOs over the last 20 or so years, including 5 in the last 4 years, 47 M&A. We don't have our total number of portfolio companies here. Maybe that's on a follow-up slide, but right now we have about 70 or 80 portfolio companies. And then recent IPOs: Accolade, Smartsheet, Redfin, Apptio, and then a recent M&A. You can see that our machine learning companies are super popular with Apple. And then a few of the other companies that have recently been acquired: Iceberg, Placed, PlayFab, Heptio, all really great outcomes for us.
Great track record. One of the questions that came up is, when you're initially making an investment, how long do you anticipate you'll be holding that investment before you have a liquidity event? And has that number changed at all over the years?
Yeah, I think so. Smartsheet, which IPO'd 2 years ago, we just exited all of our shares, I think earlier this year. So that was a day one investment for Fund 3, which was back in 2005. So that's like a 15-year hold period. Typically, when we're making a new investment, we're thinking we're going to be holding on to this investment for the next 10 to 12 years. And we want to take a board seat and be actively engaged with that company for that entire period. So I think there's a lot of venture funds that'll do like the $200,000, $500,000 seed check into a bunch of different companies, see which ones work out, and then put more money in. We've typically taken more of the approach of, we want to have a big stake, own 20%, and make sure that we're supporting this company until an eventual exit, versus have a few of the others like go to the wayside if they haven't done as well.
Mm-hmm.
So yeah, we're expecting a long hold period.
Yep.
Some other fun stats for our portfolio companies: every dollar that we've invested has driven $8 of co-investment. So over the last 18 months, we've invested $250 million, and that's been a aggregate round size of $2.2 billion invested into all of those companies. So I think this is something we like to tell our LPs, that we're getting a lot of leverage on their money, where every dollar we put in, we're getting $8 of co-investment as well. And you can see the list of other companies, other venture firms that we've collaborated with, some more so than others, but a lot of the top firms on here.
Good list of co-investors. And my guess is are you leading most of the time?
Yeah, so typically when we invest at the seed or Series A, we'll be leading it. And then I think a lot of these other firms on this list are going to be thinking like, hey, what are the best companies in the Pacific Northwest for us to be looking at? And then Madrona is going to be a great source of leads for them.
Yep, absolutely.
We do see, obviously, any slide with all the partners is competition as well. So we see more of the Bay Area firms coming up to Seattle for what they think are lower valuation, high quality deals. I think at this point, there's not really a big difference for the high quality deals between Seattle and the Bay Area.
Yep.
Just because, it's there's the internet, there's Zoom, information flows freely. And when there's good teams starting companies, typically multiple people will hear about them.
Yep.
So we're selling against these companies and we're trying to figure out how do we add value at the early stage. Part of our philosophy is we want to be close to our early stage companies. Even in an era of Zoom meetings and everyone working remotely, we think that being local helps us with helping companies find their first customers, partners, team members. That's definitely an area that we spend a lot of time.
Yep. How has COVID-19 and the current market environment impacted your deal flow and or the attraction of Seattle versus San Francisco versus other regions?
Yeah, so I think at the start of COVID, Sequoia had published this blog post about like, this is the worst event to ever happen. This is like the rest in peace good times thing. We had all these calls with our portfolio companies, having everyone revise their budgets and forecasts, update their plans. And it seems like it's actually been fine for most companies. And if you look at the big tech companies, they're all hiring more people than ever before. And just looking at Madrona's data, we've actually invested in twice as many companies as we typically do over the last 6 months. So I think we've done like 12 deals or so over the last 6 months, which typically we're doing about like 1 deal a month.
Yep.
So things have been super busy. I think the main difference is we've been seeing more of the seed 2, Series A style deals than we have been seeing like the pre-seed, seed 1 style investments. And it's probably a mix of, even if you want to start a company today and you have a team ready to go do it, it's probably going to be hard to hire your first employees, find your first customers. Cutting through the noise might just be challenging. So we've seen more of the seed deals come out of venture studios and labs and that kind of thing. But otherwise, we've been seeing more of like the later side of early companies.
Okay.
I like this slide just because it talks a little bit about what are the key themes that we're investing in. And you can kind of see the logos and how they match up. But low code, no code is an emerging area where we're doing a ton of stuff. We just announced our Coda investment a couple of weeks ago. And that's a platform where it kind of looks like a Word doc, but it has all the power of an Excel spreadsheet where you can do formulas, link to different data sources. And we're super excited about the potential of that type of platform. UiPath is obviously another company that's been doing really well in that space of how do you help people automate all of their business processes. The next 3 columns are actually one larger idea of intelligent apps. How do we fuse data and machine learning to make any sort of business application more powerful? So whether that's for Lexion reading contracts, or for Seekout helping people organize data on recruiting, or for, say, Kara helping doctors use machine learning to put data into their EMR systems about patient encounters. It's all around this larger theme of, we think every application that gets built today is going to eventually become an intelligent app that uses data, uses machine learning to build compounding advantages for themselves. Infrastructure, of course, is a big investment theme for us. So Snowflake is going to be going public soon as a data platform, but also we have a bunch of things around GraphQL, Kubernetes, AI, storage that all go into that category. And then the last bucket here is this idea of the digital transformation of consumer experiences. And I think the interesting thing about this category is basically the first generation of marketplaces like Amazon basically took an offline experience and brought it online. So I think the best example in this category is like Teladoc. It's a way to see your doctor online, but it just takes the existing doctor's experience and moves it online. I think what we're seeing with these next generation consumer experiences is, if we're going to do something online, can we just reimagine how it's done completely? So Hims is a good example of a next-gen Teladoc company, not one of our portfolio companies.
Okay.
But what they do is, for your baldness medication, instead of going to the doctor and talking to them, you will message back and forth with someone online, and then medication gets sent directly to your home. And it's kind of just rethinking that experience in a digital workflow. And some of our portfolio companies that do stuff like that, Booster and Wrench, are both really good examples. If people are buying gas for their car online or through an app, you don't really have to go to the gas station or go to the mechanic's shop to actually get those things done. Booster will just drive the gas directly to your car, or Wrench will bring a mechanic directly to your house to fix your car. So there's good examples of this kind of digital transformation of consumer experiences.
And it seems like Seattle is really kind of the hub for that segment on your chart here. I mean, there's so many leading companies that have grown up in Seattle that are doing that with
Totally.
Dating back to Amazon and Classmates and Redfin.
Yeah.
And
I think it's a lot about the marketplace models more so than just the New York, LA digitally native brands, where we're just making a cooler shoe and the branding is great and people really like it. Our companies are things like Indochino, where they've actually reinvented the process for how to get a custom suit delivered to your house. Or a Flex, where it's about like a marketplace for warehouse space, instead of just a new digital way of selling you warehouse space.
Yep.
So if any questions here, I'll pause for a sec.
Questions, anybody? Don't be shy. Katrina?
I got a question. Can you hear me?
Yep.
Go ahead, David.
Okay. Yeah, a couple of questions. First of all, going back to your earlier comments, if you're investing between, $1 and $2 million in a round that you would call Series A or Seed 2, what have you, what types of capital structures and amount of investment are you generally seeing in the companies before you put your money in?
Yeah, I'd say for those types of seed deals, we're typically going to be the first institutional investor. Maybe they've done like a couple angel investments or a friends and family round, but I'd say typically the founders are still going to own 80+% of the company for those first checks that we're doing. For the Series A later stage things, it really depends if they've done multiple seed rounds or if they have a convertible note or safe note outstanding. But typically we're trying to get in as early as we can, get our 20% ownership, and then support the company until an eventual exit.
Okay, then my second follow-up question is, at what particular, I kind of understand where you're going with the type of investments that you're making. Who screens the deals for you? If we have one here, I have one, Tom has one, we have one that think may be ready for institutional investment, how would we process that with you?
Yeah, just shoot me an email or someone else on the investment team. We can figure out who the right person to evaluate and route the deals to are.
And so from what I'm understanding also that you're actually going into the marketplace and you're doing not only B2B and infrastructure, but you're doing some B2C type situations as well.
Yeah.
Okay.
I'd say that on the B2C side, we're typically looking for what's the technology play here. So there's been a few of the like more heavy hardware investments. And for those, it's like, what's the longer term software play here? Does it make sense for us to, how can we help add value to this company? If it's manufacturing chocolate or something like that, we're probably just going to be less helpful than if it's like a new digital workflow for bringing doctor's visits online.
Okay, thank you.
Yep.
Hey, Mark Gustafson here. Quick question on, you mentioned the seed round is roughly 2 million on average.
Mm-hmm.
What are you seeing from an average follow on, given your 20% target for the life of that investment?
You mean how much we would reserve for follow-ons?
Yeah, or what is the actual, follow on to exit on that more modern seed deal?
Got it.
2x, 3x?
The way that we think about reserves is that we do it on a company by company basis. So if it's going to be really heavy, we have to build out infrastructure play, we would probably reserve more. And if it's going to be a consumer app that has lower cost to go build something, we would reserve less. In general, we're probably thinking about 30 companies in a given fund. So if we do 2 million at the seed, probably 8 million total invested on average for the company. Sorry, 10 million, so an additional 8 later on.
Wow,
Thank
so
you.
that's a multiple of 4x. That's
Yeah, so that's where it's a little bit different for every company. And then
Yep.
also if we're investing at the first stage, we might do an $8 million check for our first investment. And then maybe we only reserve, another 6 or 7 after that.
interesting. Other questions at this stage?
Okay, well, I'll keep moving. Where I didn't know this was a GIF. I thought it turned into an image in PowerPoint. But I thought it'd be interesting just to talk a little bit about some areas where I'm looking for new investments. And if you guys have ideas, please send them my way. But 3 things I'm spending a lot of time on right now are 1, low-code platforms, 2, this idea of multiplayer productivity, and 3, online communities. So in this first bucket of low-code platforms, one of the things that I've been trying to find more investment opportunities is this idea of low-code platforms that reduce friction between teams. So a lot of low-code platforms, it's helping a business analyst or someone like that write Excel-like code in order to accomplish some sort of task. I think there's more and more interfaces between engineering teams and other teams within companies as well. So a good example of this is the email marketing team has to create these dynamic email templates, and they're more used to working in like a Gmail or an Outlook style interface. Whereas when they're doing these templates that go out to customers, they need to create dynamic templates that can populate the receipt information or customize customer information for each client. And in that case, they have to work with an engineering team. If there's a way for the engineering team and the marketing team to work together on those types of things in a visual interface rather than sending code back and forth, that's a really interesting example of something that become a larger low-code platform over time. In
What's
productivity,
an example of a low-code platform company that you've invested in the Northwest?
yeah, another example of one of these is Zeitworks, which is a company out of our Madrona Venture Labs. And what they do is they help the companies that want to do RPA initiatives, robotic process automation. They help them get up and running with their RPA initiatives by figuring out what the processes are. So the typical workflow for a company to go do a digital transformation, adopt RPA, is you'll hire a bunch of consultants. They'll go sit with all your staff and map out all the processes. And that's just someone sitting next to you with their computer typing notes. What Zeitworks will do is they install a client on your computer and they just automatically track what tasks are being done. Mm-hmm. That gets fed out probably to a consultant or someone who is in that consulting type of role at a company anyway. And then they have a starting point to look at for all the different processes rather than just putting hundreds of man hours into it. So that kind of reduces the interface, if you will, between the teams that are being observed on what are their processes and the people that are actually mapping out the processes, as an example. In multiplayer productivity, the big trend here is that there's a whole category of what we think of as legacy productivity apps like Word, Excel, Photoshop, Outlook, that are all becoming, that are all being replaced or supplemented with next-gen apps that are built for collaboration. So Smartsheet is replacing Excel, Figma is replacing Photoshop, Front is replacing Outlook for different parts of collaborative use cases. And basically any sort of major productivity app is going to see a multiplayer version of it come out or emerge over the next few years. Mm-hmm. And I think there's categories here that haven't been explored as much, like the phone, making collaborative phone calls, having multiple people on the line, like the browser, being able to have multiple people on a browser instance to help with customer service or new employee onboarding. I think there's a bunch of examples of interesting things there. And then the last category is just digital communities. And I think the thing to take away here is just that as technology makes things easier to build and easier to launch, the defensibility of a lot of companies comes with their communities, their integrations, their partner networks. And if you think about Microsoft's last 3 or 4 big acquisitions with potentially TikTok, there's LinkedIn, there's Minecraft, and there's GitHub, and all of those companies are about building a community of users and hopefully figuring out what those users need and selling a product to them. So I'll pause here if there's any questions on these 3 areas, but also if you have ideas, please send them my way.
I don't have a question particularly on these three areas, but one potentially related question is on your seed and Series A investments, what is kind of the allocation between a first-time entrepreneur versus, someone that's, started a couple companies before?
Yeah, so this is something we've been looking at recently as well. I think it's about 50-50 now with first-time founders and repeat founders. I know that the first-time founder thing is always a little bit tricky. Like if we have the founders of Kubernetes who worked on Kubernetes at Google but have never started a startup before, starting a new company, it's like, are they a first-time founder or not? We are including them in first-time founders there, but about half of our companies over the last couple of years have been from first-time founders.
Okay. Any other questions on this slide? Okay, hearing none.
I just have one more slide, and it's just a plug for my newsletter. So I do a weekly newsletter about what's going on Pacific Northwest tech and startup trends, thedl.danielexley.com. Some of the popular articles from there recently have been a post on why VCs love SaaS businesses. And this comes down to a lot of things around capital efficiency and how many dollars it takes to earn a dollar of revenue. Seattle unicorns have a good comprehensive list of all the PNW unicorns over the last 20 years. And monthly deal roundup. So if you want to see all the seed, Series A, Series B, and later companies that have raised money each month, I do a roundup of those deals at the end of every month.
Huh. How long have you been doing this?
I've been doing it for about a year or so now, and there's about 2,000-ish subscribers on it. So it's a small but mighty group of people. The most influential, intelligent, great looking investors and entrepreneurs in the Pacific Northwest.
Huh?
And I invite all of you to join.
Perfect. And what prompted you to put out this newsletter?
Yeah, so newsletters have gotten so trendy in the last year. I'm almost like, oh man, what a cliche to start a VC newsletter. Yeah. But started looking into this maybe early last summer when I was having lunch with a friend who was the CTO of a local startup. And he was basically saying like, hey, every time we have lunch, I feel like I learned so much more about what's going on in the startup community. And I was like, I mean, I'm just here observing. You're actually living it. You must know way more about what's going on. And his response was, yeah, but when you're actually doing the work, you don't have as much time to read all of the news. So as someone whose part of my job is reading all of the news, it's been fun to put this together. It goes out once a week, a good summary of what's going on in the Pacific Northwest in tech.
Fantastic. Well, I will definitely sign up for this.
Cool. Thanks, Tom.
And where do you get your data from? Just by reading GeekWire and the other publications?
Yeah, GeekWire and TechCrunch and VentureBeat and PitchBook and 451 and Hacker News and just trying to consume as much stuff as I can.
Huh. Terrific. Well, I look forward to it. Excellent.
Yep. And some of it's like original content and some of it's from other people. So it's a good mix of stuff.
Huh. Well, I will be sure to feed you all the news that's fit to print from our region over here.
That sounds great. I try to make it as not Seattle-centric as possible and more about the Pacific Northwest.
Good.
One of the recent articles I really liked was about Zoom Info, which is not based in Seattle, based down in Vancouver, Washington. And my favorite data point about them was the Pacific Northwest is just so understated. If there was a $20 billion IPO in the Bay Area, it would be all over everything, like we're seeing with all these S1s coming out. But Zoom Info is based in the Pacific Northwest, and they're kind of understated. They don't talk about themselves a lot. So this $20 billion IPO, the TechCrunch article that came out about them was, so we missed Zoom Info in our news cycle last week. We're going back to report on the IPO, which is just nuts. So it's fun to have more of a Pacific Northwest focus and angle here.
What's funny, I'm getting a couple of comments here, and apparently you already, a handful of people on the call here are already subscribers to your letters. So,
oh, cool.
Yeah. Good. Well, that's your last slide. I've got a handful of questions here that I'll start moderating, but again, I'd love to have others join in. So either just kind of raise your hand, speak up, or send me or Cindy your question, and we'll queue you up. But I'll get started here. You know, one of the things that I know from my own experience with Madrona over the years, which has all been very positive, great firm, but also by going through your website, it's really very clear that you guys are active, value-added investors, and really differentiate yourself by a number of things that you do to help support your portfolio companies. So I might encourage you to kind of highlight some of those additional things that you do to ensure the success of the companies that you back.
Yeah, I think that's definitely one of the things that we try to focus a lot on. And I mean, in today's venture environment, I think every investor tries to talk about all the different ways they add value, and I think most people do. The things that we really focus on are the community and then sharing resources. So being a major part of the Pacific Northwest venture community, one of the things that's really helpful for our portfolio companies is just helping them find early hires, early partners, early customers. One of my seed investments, we recently helped them find their CTO and chief architect for the company. And we basically just used our networks and then helped them source a bunch of candidates, made a bunch of intros. They ended up hitting it off with some people. They hired these two great engineering leaders on board. And after that, we're able to go raise a really good Series A, just based on the strength of the team. Another example of things that we do are bring our companies together just to share best practices. So there's a monthly Seattle CFO call that we help to run. We'll do events with all of the CIOs within our portfolio and then invite CIOs of other companies that aren't in the portfolio as well, so they can network, potentially meet each other, share best practices, maybe become potential customers one day. Mm-hmm. And then there's a lot of things where it's just the soft connections between companies. So someone is thinking about, hey, how do I solve my brilliant jerk problem? I have this 10x engineer on my team, and I don't know what to do because he's a total jerk to the rest of the team, and I don't want to mess up our productivity. Is there someone who has some good advice on how to deal with a situation like that? And I think naturally people are in a big group environment, it's harder to share that kind of stuff. But with our smaller groups of here are CEOs of companies that got started at the same time, it's easier to ask those types of questions.
Yep. Well, based on my experience, a lot of VC firms talk about these value-added services, but it really does seem that Madrona does in fact kind of differentiate itself by following through and really rolling up the sleeves. And I've seen that in spades with working with Matt McElwain with companies here in Spokane, such as Second Watch and Worldwide
Mm-hmm.
Packets. So that really is a genuine advantage of Madrona.
We also like to think about how smart we are, and when we put out these investment themes, it helps our companies figure out where to go. But I think a lot of the work really gets done by the entrepreneurs.
Yep. We do have one question here from Nick McLean, who's got a company here in Spokane called Odd Jobbers that my angel funds have invested in. Nick, fire away.
Yeah. Hey, Daniel. Thanks for doing this. Tom, you literally took my exact question, but so to follow on, I think that finding new hires is a challenge that's particularly difficult for first-time founders or early stage companies. So what are you looking for? Like, what positions in a team are you really looking for to have a good, for the team to have a good foundation before you put your money in?
You mean when we're evaluating the team?
Yeah. I mean, what are you looking for in a team, I suppose? Got
it. Yeah, I think the thing that's really important there is just, do you have the right complement of people who can go work together to do something? And then that's on the pure team construction perspective. I think more from like an overall team and company perspective, the thing that we're really looking for is, does this team have some sort of unique market insight that other people don't? But that also makes sense that it's something that you'd want to invest in. And the combination of the group of people who can go execute, and that they have the vision of, here's an area where there's an unmet market need. That's the kind of thing that we're looking for. So I think a lot of the time we'll either have like a technical founder or more of a business founder. And the question is like, okay, well, how are you actually going to build the product? Or, okay, what's the plan to actually go sell the product? I don't think you need to have the entire team in place right off the bat. And at different stages, you need to have different people to get the company to different places. But we're just thinking about, okay, what is this current team good at? Where are the holes? Does the leadership team recognize those holes? And do they want to improve?
I'm not going to be shy. Hi, Daniel. Hi, Daniel. Margie benching with Golden Sherpa. I want to say, yes, Madrona is an amazing supportive group. I'm part of the Create 33 Startup Success Program.
Cool. Awesome.
With Rebecca. So I want to say thank you. And it is those introductions and that soft touch that has really helped us. But one of the things, the questions that I have is one, can we just, how do we, if we want to just have a conversation, we're early stage and we are right now focusing based on some introductions and conversations we've had on our vision and bringing in some amazing technology. What I was advised was go talk to the VCs and they will tell you what they're looking for. And they're basically gonna hire you, then come to me as an angel and we'll help you get there. So when I wanna have a conversation with you, how do I do that? Or what do we need to not a pitch, a conversation about what we're trying to do. And, you know, right now we're putting pieces together. So that's my question.
Makes sense. I think everyone at Madrona reads all of their cold emails. So if there's like a well-structured, not super long, but also gives you enough information that you want to dig in further email that you send to people. And it's not just Madrona. I think most VCs read most of their cold emails. That's a fine way to reach out to people. And if it's a compelling vision and pitch, people are happy to respond and learn more. I think in general, it's always better to get an introduction if you can, but it shouldn't be a deterrent if you don't know someone who can put you in touch with whoever you need to talk to. I think the thing about talking to investors early on is that it's really helpful for us to see, here's where this company was a month ago or 3 months ago or 6 months ago, and here's where they are now. And that rate of improvement, whether it's in hiring or defining the vision or product progress or customer traction, that's almost the more important data point than the exact thing that you were pitching, unless that happens just to like resonate with all the different things that a particular investor is looking for, and is it just exactly what they wanted to invest in. Otherwise, I think it's really important to see the rate of improvement on things.
Thank you.
Very good advice. So based on your experience, if I were to kind of, you know, boil it down to, you know, 3 predictors of success, what in your mind would those be? You're looking at early stage businesses, you know, what 3 things on average typically will be predictors of a positive liquidity event from an investor standpoint?
Yeah, I think the number one thing that we always go back to is team. So are these the people that can envision, build, and sell a certain product? The second thing is probably going to be market. So even if you have a great product, but the market just isn't taking off, it's always going to be hard to figure out like what's the right pathway. And I think the great teams in that scenario can go pivot and figure out what makes sense. And then the last thing that I just mentioned is I love seeing the rate of improvement. I think it was either an angel investor or an entrepreneur who told me this advice at one point, where it's just like every seed company sucks in a different way. And the most important data you can gather on them is how much better do they get each time you see them, whether that's a few months or quarters from now. So those are the 3 things that I think are really important.
When you say team, would you invest in a company that is started by a sole individual, or are you typically investing in companies that have at least 1 or 2 co-founders?
We would definitely invest in companies started by a sole individual. I think team just encompasses like what is the group of people who are going to build this thing into something big.
Okay.
And
I think I
if it
interrupted
starts,
you. Did you have something else you wanted to say on the
Nope.
3 factors of success?
I think there's some combination of things as well. So obviously team and market can't just be independent of each other. And if there's good founder market fit, that's always really important as well. And going back to that point around, do the founders have some sort of unique insight about this market?
Mm-hmm.
Do the founders have experience selling to customers in this market? That kind of stuff is also really important. And also founder product fit. Is this something the founders want to go build, or is this just an area where they see an opportunity to make a quick buck, that kind of thing?
Yep.
So I think there's a lot of interactions between these key factors of team, market, product, business model, the types of things that we're always looking at. But if I was just going to name 3, it would probably be that team, is this the right person? Is this the right group of people to go build this product? Market, is it ready for this? And are we just seeing the evidence of something big here in terms of the rate of improvement?
Mm-hmm. Okay. We have a question from Olivia. Olivia, do you want to ask your question? Olivia? Okay. We'll move on here. You know, you've alluded to a couple of times both to Madrona Labs and Madrona's Acceleration Fund. Can you talk about both of those initiatives?
Yeah, so on the lab side, we've had a couple of different projects where we started companies within Madrona and then eventually recruited a team to go out and run them. And a couple of them had done really well. So Z2 Live, which was a game studio, and then Rover, which is kind of like this Airbnb for dog sitting. And both of those had done so well. Madrona's thought was, oh, how do we make this something that happens more often? Can we turn it into a product or process? So that's when we spun up Madrona Labs and basically hired a team of startup builders to come and run this thing. Their idea is to test out a bunch of different startup ideas. And if they turn out to have good evidence of customer demand, turn it into a business and recruit a team and raise money to go run it. So Madrona Labs has probably spun out 3 to 5 companies every year for the last few years, maybe a little bit less than that, but their full-time job is basically just coming up with startup ideas, getting teams to run those startups, and then spinning them out of the lab.
What's the process for identifying those ideas?
Yeah, so there's a bunch of different things they do. Some of them revolve around bringing in industry experts to talk about, you know, what are pain points they experienced in doing XYZ type of job or industry. There's some where it's just a brainstorm of everyone in the room. Let's do these different exercises around how could we improve XYZ product that we all use. They have part of their process, I guess, is working on how do you identify these different types of things. So they have multiple different types of brainstorming, identification, and then the hard part actually is evaluating and cutting those ideas. So winning down from here's 100 things that could maybe make sense to how do we get data on each of these as quickly as possible and then cut the ones that don't work.
And then the Acceleration Fund?
Yep, and Acceleration Fund, we have a $100 million fund, and that's meant to be invested in Series B, Series C rounds for companies that have found product market fit and are ready to go and scale up and go from 5 or 10 million of ARR to 100 million ARR plus. So those are typically later stage companies. They're not in our portfolio. It's a little bit different than some VCs that have a separate fund to invest in existing portfolio companies. But those are typically around areas where we feel like we can add a lot of value, have a lot of expertise around cloud, machine learning, data, those types of things.
Okay. And those companies may be outside of the Pacific Northwest as well. Is that correct?
Yeah. And even at the early stage, we do have about 15 or 20% of our portfolio that's outside of the Pacific Northwest. But for those, typically we need to have a good reason to be doing that deal. So I think a lot of the time it's because we have a close connection to one of the founders. It's in an area where we've just been hunting for an investment and we feel like this is the team to go execute on it. But we're just less active outside of the Pacific Northwest.
Yep. Got it. A question from Corey. Corey, do you want to fire away?
Yeah, sure. So I recognize you don't have any context into our company. I'm happy to provide, 2 minutes of background, but mostly the questions around raise timing. I'm kind of curious to get your outlook on 2021. The short background is we've raised on a note. We're profitable at the moment, so we don't have to raise, but capital injection could. We're kind of at a tipping point in the company where it could make a big difference, but with COVID, with an election, is it the right time to kind of give up autonomy? Doing a raise, you're introducing risk because you're also setting, metrics that you've got to hit. It starts you down that path. Doing an institutional A round versus, your note seed is a much different animal, as you know. So I kind of curious to get your take on timing there. And just your general thoughts for the outlook for a raise, either this quarter or next quarter.
Yeah, I think the first important question is just like, does it make sense for this company to take venture capital or not? And most companies, it just doesn't make sense.
Mm-hmm.
The idea of venture is just that you have a company that can grow from 0 to 100 million in 5 years or whatever, and that model doesn't work. In terms of the timing for your specific raise, I feel like there's like the market stuff, which a lot of it you're not going to be able to control. And then there's the things that you can control. And focusing on like, here are the milestones we want to hit that we can control, I think is going to be the important part of that. So if there's an ARR goal where you feel like just given the current run rate and save the business, you're going to hit that. And given additional capital, here's how we'd spend it. And here's what we get to with that. I feel like when that calculus works out for you is the time when you should go raise. And if it doesn't work out for you, then don't think about it. The longer term implications of raising from VC versus continuing to bootstrap your business, I feel like that's going to be the more important part. And whether or not you want to have a board and what are their expectations on returns and all that kind of stuff. I think raising now versus post-election or in Q1, like no one knows what's going to happen. Obviously the stock market's all-time high and SaaS multiples are all-time high. So it's a great time to go get money if you can.
Okay. So you don't think it's a bad, I guess like we're a B2B enterprise software. We do data analytics supporting cybersecurity, IT operations, use cases,
cool,
product decisions with better data. I guess just as a brief background, so all the things line up to where it makes sense for us to raise,
okay,
I guess, to put it in summary. But it's more like, I'm not going to do that if everything's going to go to shit, if we think that's a thing. Or so I was, curious on your outlook, but it sounds like election, COVID isn't affecting how you guys are investing in your fund.
No, I think most investors are looking for more investment opportunities right now than less.
Interesting.
But I think the other thing is, if everything goes to shit, it would be great to have more money in the bank, and that could be a good stabilizer to continue to build.
Yeah, thankfully for us, we don't have that problem because we're sitting with I don't have to go into it on the call.
Yeah.
But
well, Corey, when you're ready to raise money, don't forget about my angel funds as well. I'll take that as a yes. Good. Dan Rourke, you have a question, right?
Yeah. Hey, Daniel, thanks for your talk today. On the AI machine learning front, how much are you guys involved in that space? I heard you say early in the conversation that, Seattle, the Northwest is a worldwide hub for AI. That's something that we're focused on in digital health. And I see, I've heard a lot of folks say that digital health has advanced 5 years, with COVID. How do you see that being impacted by AI? That's something that we're working on. And how many groups in the AI space are you guys really involved with?
Yeah, we've been doing a ton of AI investments. So I think we've done at least 5 UW spinouts from different computer science professors who are working on different types of AI open source projects that they commercialize, or just different types of AI software and tools to make it easier for other people to do machine learning. We've done a bunch of investments out of AI2, which is Paul Allen's institute that focuses on machine learning AI research. There's been folks from there, multiple folks from there who are venture partners with us at Madrona. So we're super deeply integrated with them. And then I think the other big source of companies is just the people who worked at those companies or were co-founders or early employees of those companies going out and starting more things are all big sources for us. I think we've seen fewer people leave Amazon and Microsoft to go start AI ML companies, but there's definitely more of that happening now as well. And yeah, we think of it more as like, here's a big trend, and not necessarily just like if someone is working on AI, it's super interesting to us, but what's the specific customer problem that people are trying to solve? And a lot of the times AI is an interesting solution.
Okay, appreciate the feedback.
Okay, we've got like 2 minutes left, and I did promise Daniel that we would finish up promptly at 1 o'clock. But before we conclude, does anybody else have any other questions? Pam, go ahead.
Hi, thank you, Daniel, for taking the time to talk with us here. I was wondering if Madrona has any particular focus on or emphasis on diversifying the demographics of the founders that you're working with, and what particular steps are you taking to do that?
Yeah, we do. And especially with all the discussions that have been happening this year, I think a lot of us at the firm are just trying to be more active and figure out, are there different ways that we can help? I think part of the challenge is always like our job is to be investors and not necessarily activists. But I think the things that are emerging as the areas where we can apply our strengths and skills is helping our portfolio companies hire more diverse talent. So connecting them with the historically black colleges and universities, making sure that they're sharing best practices on how to recruit and attract and retain diverse talent. A lot of that kind of stuff is really important to us. We're seeing more and more of our portfolio companies and encouraging them to do things like diversity pledges and getting more female board members, more minority board members. So I think there's a bunch of different things that we're trying to do. We don't have a specific we have like one goal of having one Black board member on every single portfolio company, but I think specific portfolio companies have been doing that when they get to a certain stage and feel like they can do it. And we're helping all of them share and participate in that conversation between the portfolio.
Good. We have one last question from Mike Schrock. Mike, you want to fire away?
Yeah. Thanks, Tom, for doing these, and thanks, Daniel, for the time. Sorry, I missed most of the presentation, so bear with me if I ask a stupid question, but I don't think it is. So we were a startup back in the .com days that Madrona invested in, and we had a nice exit. Unfortunately, the .com swell killed us after that exit with the CMGI. But we've always appreciated the intelligence of the team and all that. And I've been outside of startups for quite some time now in traditional enterprise. But I'm looking to get back in, and I've made some private investments since. And I want to know, I hear you talking in the SaaS terms, and I understand the value of building a SaaS company, and probably will do one in that space. I want to know, how do venture companies today, because I know this was a challenge for some of our investors, how do they like to be communicated to by the investment once they've made the investment by those founders? Do you have a standard way? Are there things that you're looking for, reports on a specific frequency, a report from the whole team or just from the founder? What are you looking at on regular communications?
Yeah, so our typical cadence when we invest in the company is we'll do a board meeting every 6 weeks. And that tends to be like the main information sharing that happens between us and typically some other investors as well. I think most people on the team, they'll also meet one-on-one with their CEOs and maybe different members of the management team every 2 or 3 weeks in between that, just to stay up to date. And that can be a more informal thing. I know some of our portfolio companies like to do, here's like a monthly update that we send out to all investors, even the smaller investors. And then the board meeting is a more in-depth discussion with more details, and we'll review like specific customer accounts and that sort of thing. But those would be the 3 general things that I see.
No, thank you.
Good. Well, we only went over by a couple of minutes here. But thank you very much, Daniel, for again taking some time out of your day to inform our community here more about Madrona. Hopefully we'll find an opportunity for Madrona to invest again in Spokane
Sounds
sometime in
great.
the future. And I did hear you say that VCs read cold emails. So I encourage anybody on the call that might have an opportunity, Corey or others, to reach out to Daniel and see if we can bring some of the Madrona funds into Spokane. And then one last thing before we sign off is be sure to sign up for Daniel's newsletter. I know I will do that right after this call. But thanks, Daniel, and thank you everyone else for participating today.
Thanks for having me. Thanks for letting me plug Madrona, plug my newsletter. It was